What if the investor who predicted the 2008 housing crash just made another move that could shake the market? Michael Burry, known for his contrarian bets and sharp market insights, has slashed his portfolio from $77 million to just $13 million. In his Q1 2025 13F filing, released 45 days after quarter end, Burry revealed that he sold nearly all his holdings and opened put options against the very stocks he once owned. Why would someone with such a strong track record make such a dramatic shift? And what does this signal for the rest of us watching from the sidelines? Let's take a closer look at what Burry's portfolio tells us right now. Michael Burry's latest portfolio move stands out as one of the most dramatic shifts we've seen from a high-profile investor in recent years. According to his Q1 2025 13F filing, Burry reduced his portfolio value from $77 million to just $13 million, an eye-opening drop of about 83%. This isn't just a routine adjustment, it's a loud signal that something's up. What's even more surprising is how thoroughly he pared back his holdings, keeping only a single stock, Estee Lauder. For someone known for carefully building positions in overlooked or undervalued companies, this level of reduction is more than unusual. It's a major departure from his typical strategy. Historically, Burry has shown remarkable patience with his investments, often holding through periods of volatility and skepticism. For nearly 2 decades, he maintained significant stakes in major Chinese tech firms like Alibaba, JD.com, Pinduoduo, and Baidu. These weren't short-term trades. Burry's commitment to these companies signaled a belief in their long-term recovery and growth, even as other investors grew wary of China's economic outlook. But in the most recent quarter, he didn't just sell off these positions. He went a step further and initiated put options against them, turning from long-term supporter to active skeptic almost overnight. This reversal is especially striking given Burry's reputation for sticking with his convictions. What could prompt such a sharp change in direction? The answer lies in the details of his new bets. In addition to betting against his former Chinese tech favorites, Burry also targeted companies outside of China. Notably, he opened put options against Nvidia, a company that has become synonymous with the boom in artificial intelligence and high-growth tech. Nvidia's soaring valuation, bolstered by excitement around AI, has made it a darling of the market. But Burry's move suggests he sees risk where others see opportunity. He also placed bearish bets on Trip.com, a travel company deeply connected to the Chinese economy and global tourism trends. Put options allows Burry to profit if those stocks fall, turning his bearish thesis into a direct wager. This approach isn't just about avoiding risk, it's about actively seeking out opportunities where he believes the market is too optimistic. By focusing his bets on companies that span different industries and regions, Burry signals a broader concern about market conditions rather than a single sector's prospects. The scale and speed of his portfolio overhaul sets this move apart from his past actions. Burry has always been known for his willingness to challenge consensus views. His warnings before the 2008 housing crash were ignored by most, but his analysis proved prescient. Now he's once again positioning himself against the prevailing optimism, this time by betting that some of the market's most popular names are due for a fall. While his contrarian streak is well known, the abruptness and breadth of this shift indicates he sees risks that others might be missing. One factor that stands out is the complete liquidation of his Chinese tech holdings, which has been a core part of his portfolio for years. The sudden decision to not only exit but also bet against these companies suggests a major shift in his outlook on the Chinese market. It's not just a matter of taking profits or reducing exposure. It's a clear signal that he expects significant headways ahead for these firms. Burry's action also highlights the growing uncertainty facing global markets, especially in relation to China. The companies he's shorting, Alibaba, JD.com, Pinduoduo, Baidu, and Trip.com, are all deeply tied to the Chinese economy and are sensitive to changes in global trade, regulations, and consumer sentiment. Nvidia, though, based in the US, is exposed to global supply chain risks and heightened scrutiny over its rapid growth and high valuation. By making such decisive moves, Burry isn't just repositioning for short-term volatility. He's making a call that significant challenges are on the horizon, and he's willing to stake his reputation and capital on that view. His portfolio isn't just a reflection of market trends, It's a statement about where he believes the biggest risk and potential rewards lie right now. Next, we'll unpack the geopolitical shockwaves behind this shift and explore why Burry, after years of betting on recovery, now sees storm clouds forming for the companies he once championed. Understanding what's fueling Michael Burry's bearish sentiment requires looking beyond the companies themselves and focusing on the environment they operate in. The main driver behind Burry's dramatic reversal is the rapidly escalating trade war between the US and China, which reached new heights during the period covered by his Q1 2025 13F filing. This wasn't just a minor policy shift, it was a full-blown economic standoff that changed the rules for global investors almost overnight. The sequence of tariff increases tells a story. After Liberation Day, the US imposed blanket tariffs of up to 67% on Chinese imports. China retaliated with tariffs as high as 125% on US goods. By March, US tariffs on Chinese goods peaked at 145%. These moves didn't just raise costs for importers and exporters, they fundamentally altered the landscape for entire sectors, especially Chinese technology firms that had previously weathered global volatility. Suddenly, companies like Alibaba and JD.com found themselves operating in a world where cross-border business was more expensive, less predictable, and subject to political whims. Tariffs like these have ripple effects that go much further than price tags. When goods become more expensive, consumer demands fall. People simply buy less. For businesses built on high-volume sales, such as Alibaba and JD.com, this creates an immediate challenge. Margins get squeezed as costs rise through the supply chain. But it doesn't stop there. These tariffs also invite fresh compliance burdens and potential capital controls, adding regulatory headaches to an already complex situation. Companies must now navigate new rules, unexpected fees, and shifting requirements just to keep operating, which can slow growth and sap profitability. The impact is already visible in the numbers. Alibaba's e-commerce growth has slowed, partially because consumers are tightening their belts in the face of uncertainty. JD.com's logistic-heavy model makes it especially sensitive to rising costs, and the company has struggled to protect its margins as a result. These aren't just isolated problems. They're signs of a broader shift affecting the entire Chinese tech sector, where once strong growth prospects now look clouded by policy risks and economic headwinds. But the trade war is only one part of the equation. Another major threat comes from the ongoing risks of US delisting threats and capital controls. For years, Chinese tech companies have relied on US stock exchanges to attract global investors and raise capital. Now, with the political climate shifting, the risk of being delisted from US exchanges has become a real concern. Just the possibility of forced delisting can spook investors, leading to capital outflows and declining share prices. This creates a feedback loop that can quickly turn a company's prospect from promising to precarious, exactly the kind of scenario that attracts short sellers like Burry. This trend is part of a larger decoupling between the US and China. Investors are left wondering what might happen if their shares in companies like Baidu or Alibaba suddenly become inaccessible due to regulatory changes. Even before any delisting occurs, the uncertainty alone can drive selling pressure as investors seek safer ground. The threat of capital controls only adds to the anxiety, making it harder for companies to attract or keep international investment. There's also the matter of global exposure. Chinese tech giants aren't just domestic players, they depend on international markets for growth. Trip.com, another company Burry is shorting, is a prime example. Trip.com's reliance on duty-free travel channels ties its fate to geopolitical stability. When travel slows or international relations sour, companies like Trip.com feel the impact immediately. These vulnerabilities aren't easily fixed. They're tied to global trends that could last for years. So why does Burry see these challenges as more than just temporary setbacks? It comes down to his focus on systematic risk. Burry has a track record of spotting when the market is underestimating long-term threats. In this case, he's not reacting to a single quarter of bad earnings. He's responding to a convergence of factors: aggressive tariffs, mounting regulatory obstacles, and rising geopolitical tension. These pressures combine to create a tough environment for growth, making a traditional recovery less likely. Given all this, it's clear why Burry would exit his stakes in Chinese tech and even bet against them. The risks aren't just about short-term volatility. They reflect a deeper uncertainty about the future of these companies under the current global conditions. But there's one odd position he still holds. Stick around to see why. Estée Lauder stands out as Michael Burry's only remaining position, and that choice raises a lot of questions. Why would a famously bearish investor hold on to a cosmetic company when he's betting against so many others? The answer likely lies in a blend of market psychology and classic contrarian value investing. One key idea is the lipstick index, introduced by Leonard Lauder, Estée Lauder's former chairman. This concept suggests that during tough economic times, people cut back on big expenses but still spend on small luxuries, like lipstick. Instead of splurging on vacations or gadgets, consumers might treat themselves to affordable indulgences. For companies with a diverse lineup of beauty brands, this behavior can create a cushion during downturns. Estée Lauder's portfolio includes MAC, La Mer, and Clinique, all of which appeal to shoppers looking for a bit of luxury without breaking the bank. For Burry, this dynamic could offer a hedge against the widespread economic weakness he's anticipating. Still, Estée Lauder hasn't escaped the challenges facing global markets. The company's stock has suffered an 82% decline from late 2021's highs, a steep drop that reflects a mix of shrinking revenues, especially in Asia-Pacific, and disruptions in travel retail channels. Duty-free airport shops, cruise ships, and international train stations once fueled much of Estée Lauder's growth, but those sales channels have yet to fully recover. The result is a company that's lost momentum in key markets and is now working to rebuild. This sharp decline is exactly the kind of scenario that tends to catch Burry's eye. He's known for seeking out cigar butt opportunities, companies that the market has beaten down, but where a final burst of value might remain. Instead of holding for years, Burry often pounces on overreactions, then exits on a first sign of recovery. In Estée Lauder's case, the dramatic sell-off could signal to him that investors have overcorrected, creating a temporary window for gains if sentiment shifts. What makes this even more interesting is that Burry's position in Estée Lauder is probably not a long-term commitment. The company itself is in the midst of a major restructuring. Management has launched a multi-year plan to cut up to 7,000 roles and boost operating profits by $1.4 billion by 2026. There's also a leadership transition underway, with a new CEO stepping in to steer the turnaround. If these changes start to show positive results, even small ones, it could be enough to spark renewed investor confidence and drive a quick rebound in the stock price. That creates a potential exit point for Burry, who has a track record of taking profits when a beaten-down stock shows early signs of recovery. Brands like MAC and Clinique give him confidence there's a quick rebound if the turnaround plan gains traction. Even during tough periods, these names have a loyal following and global recognition, which can help stabilize the businesses while it works through temporary headwinds. For a contrarian investor, this brand strength acts as a buffer, reducing the risk of a total collapse while leaving room for a swift bounce if conditions improve. Estée Lauder, then, represents a company with solid fundamentals, facing short-term setbacks, an ideal setup for someone looking to capitalize on market overcorrections. If Burry's play here is about capturing a short-term rebound rather than betting on a long-term transformation, it says something about his broader view. He's not just bracing for volatility, he's being extremely selective, choosing only the opportunities where the risk-reward profile lines up with his thesis. In this case, he's wagering that even in a weaker economy, shoppers will still reach for small luxuries, and that Estée Lauder's battered stock has room to recover as restructuring efforts take hold. Ultimately, Burry's decision to hold just one stock while betting against so many others is a reminder that every move in his portfolio is deliberate and signals a calculated view of the market. But before you rush to copy his strategy, it's crucial to understand what these moves really mean and what they don't. For aspiring investors, Burry's headline-grabbing trades offer more than just a peek into a famous portfolio. They highlight the importance of context and independent thinking. The 13F filing that reveals his moves come with a built-in delay. They're released 45 days after the quarter ends. By the time you see what Burry did, the market may have shifted and his position could be entirely different. As this video's source puts it, all the information we're getting now is old news. This lag is especially important when you consider that Burry, while rooted in value investing principles, often acts like a short-term trader. Unlike Buffett's multi-year holdings, Burry's moves can reverse before we can even see them publicly. So while his actions are interesting, they're far from a real-time playbook. It's easy to be tempted by the idea of mirroring a legendary investor's portfolio, especially someone with Burry's track record. But copying trades without understanding the reasoning behind them can be risky. The 13F filing shows what Burry held at a specific point in time, but they don't reveal his strategy, his research, or his risk tolerance. You're only seeing the tip of the iceberg without the why behind the what. This lack of transparency can lead investors to make decisions that don't fit their own goals, timelines, or risk appetite. Instead of focusing solely on what Burry bought or sold, look at the broader factors that influenced his decisions. For example, his recent moves were shaped by macroeconomic events like escalating tariffs and the threat of Chinese companies being delisted from US exchanges. If you want to learn from his approach, start by monitoring tariff announcements and policy changes that could impact the companies or sectors you're interested in. Pay attention to shifts in global trade dynamics and regulatory headlines. These are the kinds of catalysts that drive big portfolio shifts for investors like Burry. Another takeaway from Burry's strategy is the value of independent, contrarian thinking. He's known for questioning the consensus and searching for overlooked risks or opportunities. This doesn't mean you should always bet against the crowd, but it does mean you should dig deeper than surface-level narratives. Ask yourself, what are the market's assumptions? Where might sentiment be too optimistic or too pessimistic? For instance, Burry saw that the risks from US-China tensions weren't just temporary. They could lead to long-term structural changes in the market. Adopting this mindset can help you spot vulnerabilities or opportunities that others might miss. However, a contrarian approach only works when paired with solid risk management. Burry's use of put options is a good example. They can offer big rewards, but they're also risky. Options timing is tricky. They can expire worthless. So most investors should balance with traditional holdings. Diversification is key. Spreading your investments across sectors and asset classes can help protect you if one bet doesn't pan out. Respect the risks and don't concentrate your entire portfolio around a single narrative or strategy. There's also a practical limitation in trying to follow Burry's trades. 13F filings don't disclose the strike prices or expiration dates of his options, so it's impossible to know the exact risk or upside he's targeting. This lack of detail makes it even more difficult to replicate his approach or predict his next move. Instead, use these filings as a prompt to think about the bigger picture. What trends or risks are emerging in the market? How do they fit with your own investment goals and risk tolerance? Burry's recent actions highlight the importance of questioning assumptions and thinking critically about where the market might be headed. His portfolio isn't a shortcut to easy gains, it's a signal to look for vulnerabilities and to challenge popular narratives. By focusing on your own research, monitoring key macroeconomic indicators, and maintaining a diverse portfolio, you can build a strategy that's resilient to sudden market shifts. Next, we'll consider what cracks in the market these warnings might reveal and whether it's time to brace for a downturn. Michael Burry's latest portfolio shakeup isn't just about warnings. It's a masterclass in how to challenge conventional wisdom. Selling 83% of his holdings and betting against major industries shows how quickly a seasoned investor can pivot when external conditions, like the escalating US-China trade tensions, change the landscape. His actions remind us that even the most stable investments can face unexpected risks. Instead of following the crowd or copying famous investors, use this as a prompt to think critically about your own strategies. If you found these insights valuable, hit like and comment below on whether you plan to rethink your portfolio. Now it's your turn. What questions will you ask before your next trade?